The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Welcome to another episode of the Fix It Friday edition of the Crazy Wealthy podcast. Thanks for joining us. So today I'm going to talk about a common question that I've been getting particularly for the past month. Happens on and off during most crises, but because of everything that's going on right now, I've been getting it quite often. And that question is, Jonathan, how could the stock market be going up like it is when the world is coming to an end? Literally, that's a quote from more than one person. And I understand it. The current events are what we focus on, particularly with the 24/7 media outlet that's putting all of the chaos in our face all day long and all night long.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Let's answer the question. How can the market be going up with all this going on? The war in Iran and Israel, the price of oil spiking 2 days, 20% in March, and on and on and on, the politics. So oil prices, while they spiked 20% in just 2 days back in March, didn't stay at those levels. So we'll talk about that in a few moments. There's recession talk. An election's coming, tariffs, politics, feels overwhelming to almost everybody. So when people say this doesn't make sense, they really don't understand the reaction of the markets to all this news. But here's the Fix It Friday idea I want to talk about today. Most of what we're reacting to emotionally is what I call noise. And what actually drives long-term investment outcomes is what I call the signal. Noise versus signal. What an important clarification. Let me be clear about something because this part matters. When people hear advisors say things like markets don't move on headlines or fear, that can sound wrong because obviously prices jump around, what we call volatility, when bad news hits and is advertised. That's very true. Markets completely react to noise in the short term. That's volatility. Wars, oil spikes, scary headlines, political drama, those things can and do move stock prices around day to day and week to week. But here's the critical distinction. Short-term price movement is not the same thing as long-term growth. Volatility responds to the noise, the political issues, the wars, the inflation, the pandemic, etc. Compounding long-term responds to the signal, earnings. It's, as I said many times, earnings and only earnings that drives long-term stock prices, not these other things that we call noise. Over longer periods of time, the signal that matters the most are those earnings, the underlying ability of businesses to make money and grow profits. And the reason that companies continue to make money and grow profits is twofold or threefold. So when we have crises, companies are rational. They're not like Western governments who during crises might loan out more money and take on more debt. Companies do the opposite. They'll pay down debt, they'll lay off workers, they'll do whatever's rational for the second reason that they keep growing, which is the CEOs and leaders of these public companies have a fiduciary duty to maximize our value as shareholders. And that's exactly what they do, maximize value. And third, to minimize losses. So we need to combat the narratives that are opinion-based, which is, gosh, with this war and the spike of oil, markets have to go down. Opinion-based narratives with actual facts. So let me do that. So while we're still early in earnings season, as of mid-April, about 10% of the Standard & Poor's 500 companies have actually reported earnings. 88% of those companies have beaten earnings expectations, and that number really matters in context because historically, the 5-year average earnings beat rate is about 78%, and the 10-year is about 76%. So far this earnings quarter, having 88% beat the earnings is dramatically better than long-term averages, not just good. And so that again can confuse a lot of people. But again, that's the signal. Earnings are good. The market's not really going to focus on the short-term current events. So why that explains what feels so confusing when earnings are coming in that strong. Analysts do not rush to cut forecasts. Companies don't panic with guidance, and investors don't permanently reprice businesses lower. So even though headlines feel unsettling, the market's saying, so far, the businesses themselves are holding up. That's why you can have wars, oil shocks, recession talk, and still see markets trend higher over time. And the oil spike, as I promised to come back to from earlier in the discussion, is the perfect example. Oil is where a lot of people get stuck. Oil did spike sharply in March, up 20% in a couple of days. And emotionally, that felt like it had to break something, particularly the stock market. But what actually happened? Oil didn't stay elevated. Earnings forecasts didn't collapse, and companies absorbed cost pressures better than feared or passed them along to the consumers. The market didn't ignore the shock. It processed it, adjusted, and moved on. Short-term volatility showed up. Long-term earnings power stayed intact. Why this always feels wrong in real time. Incidentally, this has a lot to do with what I talked about in the previous episode, or one of the previous episodes, number 23, called the rear view mirror trap, hindsight bias. It's worth revisiting if you haven't listened to it. I suggest that it might be a good time to listen to it because it talks about the fact that the current crisis feels worse than all the others, not because of the severity relatively of this crisis versus the others, but because of resolution. All of the others have been resolved. This one still has the perceived uncertainty surrounding it. When and how will it get resolved? And so that's called the rearview mirror trap or hindsight bias. Again, episode 23 is worth revisiting there. But every major stress point feels like this time should be different. The pandemic felt uninvestable. The financial crisis felt like the system was going to break permanently, and wars always feel like they have to derail markets. And yet, historically, markets don't wait for clarity. They move before it. Why? Because earnings stabilize long before headlines improve. So the fix this Friday, yes, markets do move on the noise in the short run. That's volatility. But over time, prices follow earnings, not fear. And I'll close with a quote that captures this better than anything I could have said myself. It's from a gentleman named Fred McLean, who's the president of Heritage Investment Group, which CNBC recently ranked as the #1 advisory firm in the country. What Fred said was, quote, "We are very long-term investors. We do not engage in market timing, stock picking, or tactical asset allocation on any level. We don't react to market movements or economic news." The key takeaway here is this: tactical allocation, which it means simply changing our portfolio strategy, not to reflect what we initially put together to meet our multi-decade financial goals with the highest probability, but tactical allocation is when we change that plan in response to every short-term economic forecast and market move. Tactical allocation is in our view, disastrous to success. So tactical allocation reacts to noise. Strategic allocation, which is what did I put together in my portfolio when I did my plan? More investments that make 7% a year after inflation than 3% a year, meaning more stocks than bonds. That's my strategic allocation, and that should stay intact through all the noise. Strategic allocation is the plan that keeps you invested long enough for the compound to work. Volatility responds to the noise. Long-term wealth responds to the signal. Stay focused on what matters. And thanks for tuning in to this week's Fix It Friday. You can catch us on all your favorite podcast venues, crazywealthypodcast.com, as well as fusionfamilywealth.com.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.